Okay, so guys, let us start with the chapter on where you're going to learn about what is
Rights, buyback and bonus.
now regarding rights issue, bonus and stock or share buyback. Now, what is the financial impact of a bonus issue or a share buyback or rights issue? Now, that is what you want to look into. Now, do not search for this chapter in your study material. The sums on rights issue, buyback and bonus is a part of chapter 5 in your study mat on security valuation. Now let's go ahead and take on an example on the financial impact of a bonus issue. So this is something we're going to take up. Yes, read the question, Renuka.
So Tripti Company Limited, promoted by a multinational group, International INC, is listed on stock exchange holding 84%, that is 63 lakh shares.
Point to note. So there is a promoter group holding 84% of the issued share capital of the company, and they are holding 63 lakh shares. Now guys, take a calculator, do this calculation for me. If 84% of the shares outstanding are 63 lakh, what is 100%?
75.
It is 63 lakh into 100 by 84, which will work out as 75 lakh shares. Now I can say that out of 75 lakh shares issued by the company, it is 63 lakh shares are held by the promoter group. That means the balance 12 lakh shares is nothing but a free float being traded in the market. Is that fine?
Yes, sir.
So out of 75 lakh shares, I can say 63 lakh is held by the promoter group, and the balance 12 lakh shares are free float. That is the shares that are trading in the market. In all, there are 75 lakh shares. Next.
Yes, sir. Profit after tax is 4.8 crore rupee.
It is given that the PAT, that is the profit available to the equity holders, that is the holders of equity instrument, is rupees of 4 crore and 80 lakh, right? 4.8 crore, am I right? Now if you want, you can also calculate the EPS currently. Now guys, take a calculator, do this for me. So rupees of 4 crore and 80 lakh, divide that by 75 lakh equity shares in issue. So that will give the earnings per share. 4 crore 80 lakh by 75 lakh. How much you get?
It's 6.4, sir.
6.4. So that is supposed to be the earnings per share. Next.
Free float market capitalization is 19.2 crore rupees.
Point to note. The free float market cap, nothing but the market value of the 12 lakh shares held by the public, right? Remember the 12 lakh shares free float.
Yes.
The market value of these shares is rupees 19 crore
20 lakh.
and 20 lakh. In case you divide rupees 19 crore and 20 lakh by 12 lakh shares, you will get the market price per share. Is that clear? In case you want to find the price per share, you guys can go ahead and divide rupees 19 crore and 20 lakh by 12 lakh shares. That will work out 160 rupees, right?
Yes.
160 per share. Next.
Yes,
Can you find the price earnings ratio? Why not? Now we know the market price per share is rupees 160. We also know the earnings per share is 6.4 rupees. Now you can divide 160 by 6.4 to get the price earnings ratio at present.
25.
Is that fine? 25 times is your price earnings ratio. Next.
Yes, sir. So as per SEBI guidelines, promoters have to restrict their holdings to 75% to avoid delisting from the stock exchange.
What is the meaning? There are two ways of doing it. Now tell me what is 75 lakh shares into 75% or into 3 by 4.
56.25.
That means what? Now they are right now holding 63 lakh shares in the company. Now they are supposed to sell some of the shareholding,
6.75.
around 6 lakh and 75,000 shares, and reduce a shareholding to 56 lakh and 25,000 shares, right?
Yes, sir.
That is one way. Or what they can do is they can put extra shares in the hands of the minority shareholders, the free float, thereby reducing their percentage. How does it happen? I'll tell you. Take 63 lakh to be how much? 75%. Do this for me. What is 63
84
lakh into 100 by 84%? 100 by 75 will work out to how much?
84 lakh.
That means the total shares in issue should be 84 lakh. Minus 63 lakh held by the promoters anyway. They don't want to sell the shares. So what is the difference? 21 lakh shares should be held by the minority shareholders. Understood?
Yes, sir.
Out of 21 lakh, how many shares are currently held by them?
12
lakh shares.
So 9 lakh.
That means you have to give them extra 9 lakh shares. You got to put extra 9 lakh shares in their hands so that the promoters' percentage holding will fall to 75%. Is that clear?
Yes, sir.
That is more of a deemed disposal. It is as good as a promoter selling their excess shares, right? By giving bonus shares to the minority shareholders,
Yes.
the promoter's percentage holding will reduce to 75%. Now there are two ways out. Let's see what they're going to follow. Yes.
So board of directors has decided not to delist the shares but to comply with the SEBI guidelines by issuing bonus shares to minority shareholders while
Very clear.
maintaining the same PE ratio.
But they want to maintain the same price earnings ratio. Now it's given that they want to give bonus shares to the minority shareholders. That means you got to give them 9 lakh bonus shares, right? That means holders are 12 lakh shares, a free float, or the minority shareholders will be given 9 lakh bonus shares. I can say for every 4 shares, give them what? 3 bonus shares. Because 12 lakh, 9 lakh, right?
Yes, sir.
So 4, 3. Therefore, for every 4 shares, it is 3 bonus shares are given to the minority shareholders. Therefore, the total number of shares will become how much? 84 lakh shares in all. Got it?
Yes, sir.
And that will reduce what? The earnings per share. Suppose the same earnings, that is 4 crore 80 lakh is the earnings available. Now what will happen to the EPS now? You'll be dividing 4 crore and 80 lakh by how many shares? 84 lakh shares. You'll get the new EPS after bonus issue. Got it? And that into P ratio 25 times will give the new share price after bonus issue in case a company wants to maintain the same price earnings ratio. Next.
Yes, sir. So calculate P ratio, bonus ratio, market price of share before and after the issue of bonus shares, free float market capitalization of the company after the bonus shares.
Very, very clear. All these what I discussed, right?
Yes.
Now, very important, some guys from examination standpoint. Here we go with the solution. Yes.
So first they calculated the P ratio.
Which
So
is nothing
first-
but
So first they made a box with particulars, percentage of holding and number of shares column.
okay.
So promoters holding 84%, 63 lakh shares. Minority holding 16%, 12 lakh shares. Total shares 100%, 75 lakhs.
Is that fine? So 63 lakh represents 84%. You can find what is for 100% or find what is for 16%. You can divide 63 lakh by 84 into 16 will give you, what is 16? The balance, 16% will give you 12 lakh shares. Therefore, the total holding will be 75 lakh shares. Next.
Free float market capitalization is 19.2 crore rupees. Hence, market price is 19.2 crores divided by 12 lakhs, 160 rupees per share.
Rupees 160 per share is the market price. Next.
EPS, PAT by number of shares, which is 4.8 crores divided by 75 lakh, which is 6.4 per share. So next is the PE ratio, 160 rupees divided by 6.4, which is 25 times.
Remember, all these we discussed, right? So finding out the 75 lakh shares and finding out the EPS 6.4 and then calculating the market price to be 160. Also finding out the PE ratio to be 160 by 6.4, 25 times. All these are before the bonus issue. Next.
The number of shares to be issued, promoters holding 84% is 63 lakh shares. Shares remains the same but holding percentage to be as 75%. Therefore, 63 lakh divided by 75%, the total shares should be 84 lakh shares.
So 63 lakh into 100 by 75 equals 84 lakh shares, right?
Yes.
Next.
So shares of minority is 84 lakh minus 63 lakh, which is 21 lakh.
That is a non-promoters holding is going to be 21 lakh. Of this 21 lakh non-promoters holding, we know 12 lakh was already held by them. Bonus is 9 lakh shares.
So bonus 9 lakh for 12 lakh. That is 3 bonus shares for 4 held. Or 0.75 shares for 1 share.
That's it. If you want, you can do that. Otherwise, 3 bonus for every 4 shares. Next.
Number 3, market price before and after bonus. Before bonus, it is 160 rupees per share.
Already we know. Then
after bonus, it is new EPS 4.8 crore by 84 lakh shares, 5.71 rupee.
Now that into 25 times, they want to maintain the same PE ratio anyway, right?
So new market price is 25 times into 5.71, 142.75.
And you all know that price earnings ratio into EPS is what? Market price. You're going to bring forward knowledge from the chapter corporate valuation. Yes.
Free float capitalization is 142.75
per share
into 21 lakh shares.
That's all.
Which is 29.9775 crores.
Basically, the market value of the non-promoters shareholding. That is a free float market cap. 21 lakh shares into price per share after bonus will be the market cap, right?
Yes, sir.
Of non-promoters holding. So guys, pause the recording and jot down the solution in your notebook.
Yes, sir.
So now we shall go ahead and take on examples on rights issue. And you all know this from your CA intermediate law, that a company makes a rights issue in case it is in need of capital. The company can issue shares to the existing shareholders to expand the business, for example, right? Now let's go ahead. We have 3 examples on rights issue. Yes.
So Pragya Limited has issued 75,000 equity shares of rupees 10 each. The current market price per share is rupees 24. The company
Listen. So the issued shares are 75,000 on the balance sheet of the company. Face value rupees 10 per share. And these shares are currently trading in the market for rupees 24. Next.
The company has a plan to make a rights issue for of 1 new equity share at a price of rupees 16 for every 4 shares held.
Now guys, take a calculator. What is 75,000 shares into 1 divided by 4?
18,000.
That means a company is planning to issue 18,750 rights shares, not bonus, not free of cost. Okay, no free lunch. 18,750 shares will be allotted to the existing shareholders, but they are supposed to pay rupees 16 per share. And you notice 16 is way below the 24 rupee market price, right?
Yes, sir.
That is why you learn in Ind AS number 33 as well in your FR, there is a bonus element in a rights issue. Because the right shares are offered below market price. It is a discount. It is issued at a discount on market price, not discount on face value, discount on market price. So now tell me, what is 18,750 shares into rupees 16 per share? 18,750 into rupees 16. How much you get?
3 lakh.
3 lakh is it? Now that is the amount of money maybe your company needs for expansion purpose. Now it's a very small amount. Okay. It's a very old CA final examination question. But rupees 3 lakh is the amount wanted by the company for expansion. Got it?
Yes.
Now, you know how they would have got that one for every 4 shares? They would have done this. They want rupees 3 lakh money and they're going to issue shares at rupees 16 each. So, if you divide 3 lakh rupees, the money required by 16 rupees, the rights issue price fixed, will give you 18,750 shares to be issued. And when you compare 18,750 with 75,000, you'll get one right share for every 4 shares. Got it?
Yes, sir.
Next.
Yes, sir. You are required to number 1 calculate the theoretical post rights price per share.
Listen, you have been asked to calculate the theoretical X rights. That is EX, excluding rights, or post rights share price. That means what? What should be the share price after the rights have been exercised? It is called theoretical X rights or post rights share price. Next, number 2.
Number 2, calculate the theoretical value of the right alone.
Calculate the value of the right, that you will come to know that at what price the rights can be sold. The right, not the share. The right to buy that one share can be sold, right? Next.
Number 3, show the effect of the rights issue on the wealth of the shareholder who has 1,000 shares, assuming he sells the entire rights. And number 2, show the effect if the same shareholder does not take any action and ignores the issue.
Okay, there are 2 cases given, but I'll introduce one more case later.
Yes, sir.
But how to calculate the theoretical X rights share price? Very simple logic. Now, let us say you are a person who do not have shares in this company, but you want that one share, you want to buy that one right share at rupees 16 each. What you can do? You can first go to the stock market and buy the 4 shares in the company. Got it? Now, every share will cost you how much? 24 rupees. Yes or no? So, 4 shares you buy at rupees 24 each. So, what is the amount you have spent?
96.
You have spent rupees 96 on 4 shares. Now, what happens? Now, you have the right to buy 1 share in the company because you're holding 4 shares, right?
Yes.
Now, you have the right to buy 1 share at rupees 16 per share. Now, what is 1 share into 16?
16.
That means you pay another rupees 16 and get that 1 share. Therefore, what is the total amount is spent? In all, rupees 112. If you add 96 and 16, any doubt you ask Alexa, okay, and I do that. Or consult your calculator. How much you get? 112 rupees per share. So that's for how many shares?
5 shares.
Exactly, my dear friend, 5 shares. Now, what is the average price per share you paid? Divide 112 by 5, which is equal to
22.4.
rupees 22.4. That is all. As simple as that. And that is supposed to be the theoretical X rights price. That means in theory, the price of 1 share should be rupees 22.4 after you buy that 1 share from the company at rupees 16 per share. Is that fine?
Yes, sir.
So that is a theoretical X rights fair value or the price of a share. Rupees 22.4. Now, how to calculate the value of right? There are 2 ways of finding out. Either you can learn this formula, you can memorize this formula. What is that? The theoretical post rights price of a share, how much? 22.4 minus 16, the rights issue price, how much? It is 6 rupees and 40 paise is a value of the right. But the real understanding will be, it goes this way. You guys remember you went to the market and bought 4 shares?
Yes, sir.
At rupees 24 per share. But what is the X rights value? 22.4. What you got? That means what? The 24 rupees what you paid is the dirty price. We say DP. What is DP? Dirty price. Whereas 22.4, why is dirty price? That is cum rights. That's 24 rupees. 22.4 is called the CP. What is CP? Clean price. That is after you remove the rights from it. Now you should tell me what is 24 rupees minus 22.4. That means for every share that you bought in the market, you bought 4 shares, right? For every share you paid 1.6 extra. That is the amount you paid for the right that is attached. So how many shares you had to buy to get 1 share? 4.
4
right?
shares.
What is 4 into 1.6 per share?
6.4.
Exactly, my dear friend. That's it. So 4 into 1.6 will give you 6.4. Or the best, what you should do for examination purpose will be use a formula, take the theoretical X rights or post rights share price minus the rights issue price.
Yes.
22.4 rupees minus 16 rupees will give you 6.4 rupees per
Share.
right.
Right. Yeah.
For a right. That is the value of a right. Got it?
Yes, sir.
Don't say per share, that is the value of a right. Next. I think they give an alternative solution also.
So should I read one by one? First one.
Which one?
First one, should I read?
That's
The
all.
formula what they gave, no?
Yeah. We're going to take up that. We're going to take up that. Okay.
So calculation of
yes.
theoretical post rights or X right price per share. They given us a formula, sir. M market price into N number of old shares for a right share plus subscription price into right share offer divided by number of old shares plus right share offer.
The same thing, right? 24 rupees into 4 shares plus 16 rupees into that 1 share. The whole divided by what?
5 shares.
It is 5 shares. You can do this way. You can also take 75,000 shares as a whole. Have they done that? No, they haven't.
No.
They have done only 4 into.
Only-
Okay, no problem. Okay, you can also take 75,000 shares into 24 plus 18,750 shares into 16. The whole divided by 75,000 plus 18,750. Is that fine? But I'll advise don't do that. Just do it 4 shares,
Yes.
24 rupees. 1 share 16. The whole divided by
5.
5. Now for this I have an alternative understanding. The 22 rupees and 40 paise is nothing but. Can we have the handwritten?
Yes.
It is a weighted average share price. So what are the weights? It is 4 shares you buy old shares. You get what? 1 right share, right?
Yeah.
So what are the weights? 4 by 5 and 1 by 5. So 4 by 5 into 24 rupees. The 24 rupees, that is given a weight of 4 by 5, 0.8 weight. And then 16 rupees into 1 by 5 will work out to how much? 19.2 plus 3.2 will work out to rupees 22.4. Got it?
Yes, sir.
That is another way to understand the theoretical X rights or post rights share price. It is a weighted average of the share prices. Next.
Yes, sir.
Value of right.
So calculation of theoretical value of rights alone. X rights price minus cost of rights share, which is 22.4 minus 16, 6.4.
Remember, that will suffice in the examination. If you want, you can show the working 6.4 by 4 because you had to buy 4 shares to get 1 right share, right? You can divide 6.4 by 4, 1.6 value of right per old share.
Yes.
Got it? But there is another way to get 1.6 is 24 minus 22.4. But I will suggest stop at 6.4. That will suffice. Now you have been asked, what is the impact on the wealth of a shareholder? Holding 1,000 shares. That means what? Out of 75,000 shares issued by the company, let us say 1,000 shares are held by Renuka ma'am.
Yes, sir.
Now, what is the impact of her wealth, impact on her wealth, okay, because of this rights issue? The two scenarios given. When the rights are sold, that means what? She decide not to buy the shares. She's going to sell the rights in the market to somebody else. She can sell the right to another shareholder who will buy the shares of the company, okay?
Yes, sir.
And another case is what? No action is taken by Renuka ma'am. But I want to take one more scenario.
What if X?
Where she's going to buy the 250 shares. How we got 250, no? She's holding 1000 shares into 1 by 4 is what? 250 right shares. Just see the first case.
Yes, sir. Calculation of effect of rights issue on wealth of a shareholder who has 1000 shares, assuming he sells the entire share.
Yeah, rights.
So value of shares before rights issue is 1000 shares into 24,000 rupees.
Very clear. Right now she's holding 1000 shares out of the 75,000 shares, right? And the shares of the company are trading at 24 rupees. So 1000 into 24, 24,000 rupees is a wealth of Renuka ma'am before rights issue. After rights issue,
1000 shares into 22.4.
that's all. She is not buying the 250 shares, right? So 1000 into 22.4 is rupees 22,400. But add a proceeds from the sale of rights.
So
she has a right to buy 250 shares, right? So 250 rights are sold at rupees 6.4 per right. How much you get?
So 1,600 rupees.
Add
in
both.
all 2,400.
24,000.
Oh, sorry.
No
24,000
change in-
after rights issue.
No change in wealth. Even before 24,000 wealth, even after
24,000.
she is holding 1000 shares are trading at 22.4 per each, and proceeds from sale of right cash comes in. She has shares worth rupees 22,400
Cash.
and cash of rupees 1,600 from sale of rights. Therefore, her total wealth or the total value of financial assets she is holding is 24,000 rupees. Is that clear?
Yes, sir.
Now, what if no action is taken? Very simple. Before rights issue, 24,000 wealth. After 1,000 into 22.4, how much? 22,400. That's it. So, what is the loss in the wealth?
1,600.
Is a loss
Yeah.
to her. But there is one more scenario. What is that? What if the right shares are bought by her? Just see, I've done a small working out there, handwritten notes.
Yes.
She'll be holding 1,250 shares, trading at 22.4 each. Close bracket, that is 28,000 rupees in shares. But remember, she had to spend, she had to pay 250 shares into 16 rupees to the company, 4,000 rupees cash going out. So what is her net wealth? Is 24,000. Even before rights, what? Her wealth was 24,000. That means what? When the rights are sold or when the rights are exercised, her wealth does not diminish. Is that fine? In case no action is taken by her, her wealth will diminish.
Decrease.
Is that fine?
Yes, sir.
Got it? So guys, go ahead and jot down the solution in your notebook.
Yes, sir.
Okay, now we shall go ahead and take on this extra sum that reads Ray Gold Limited. Okay.
Yes, sir.
Now let's go ahead and take on Esma. Read the question.
Ray Gold Limited has a paid up ordinary share capital of rupees 200 lakh represented by 4 lakh shares of rupees 50 each.
So it's given that there are 4 lakh shares in issue and face value rupees 50 per share. That is why 4 lakh into rupees 50 face value. Rupees 200 lakh is
The capital.
the paid up share capital. Next.
Earnings after tax in the most recent year, which is 2009-10, were rupees 80 lakh, of which 26 lakh and 50,000 was distributed as dividend.
This number is not relevant to calculate EPS. I need the net profit available to shareholders, which is rupees 80 lakh.
80 lakh.
Doesn't matter how much of this is paid as dividends and how much is retained by the company. That doesn't matter. Now with this number rupees 80 lakh and 4 lakh shares issued, I can calculate the earnings per share.
Ah.
If I divide rupees 80 lakh by 4 lakh shares, I get rupees 20 per share as EPS.
Yes.
Next.
The current price earnings ratio of these shares as reported in the financial press is 8 times.
So based on this ratio, I can say the company shares are trading at, it is 8 times rupees 20. That is the P ratio is 8. That into rupees 20 earnings per share.
160 market
Rupees 160 is the current market price. Therefore, the Financial Express would have calculated the ratio by dividing the company share price by EPS, right?
Yes, sir.
Therefore, 160 by 20 would have given them 8 times. So, therefore, 160 is the current share price. Next.
The company Raygold is planning a major investment that will cost 240 lakh rupees.
You know, 2 crore 40 lakh is the amount of money they need for expansion. Okay. Next.
And is expected to produce additional after-tax earnings over the foreseeable future at a rate of 15% on the amount invested.
So, have this in mind, this 240 lakh will generate a return of 15% if invested in the expansion project. Is that fine?
Yes.
Next.
The necessary finance is to be raised by a rights issue to the existing shareholders at a price of 25% below the current market price of the company
Now,
shares.
what is the rights issue price? We know the current market price rupees 160.
160.
On that 25% less, that is 40 rupees less.
120 rupees.
So 120 is the rights issue price. That means your company is planning to raise rupees 2 crore and 40 lakh. That's the amount of money you want from the shareholders. And you're offering shares at rupees 120 per share.
Yes, sir.
So if you divide 240 lakh or 2 crore and 40 lakh by 120 rupees a share, you will get how many shares? 2 lakh shares.
Yes, sir.
That means a company has to make a rights issue of 2 lakh shares at rupees 120 per share, right? Which is 70 rupees higher than the face value. Yes or no?
Yes, sir.
Face value 50. Rights issue price 120.
120.
But remember, the 120 is anyway below the current market price. Got it?
Yes, sir.
Now, please remember, that means the holders of 4 lakh shares currently are given the right to buy how many shares? 2 lakh shares.
2 lakh shares.
That means for every 2 shares,
One
1 share. For 4 lakh, 2 lakh. For that is nothing but 2 is to 1. You can say for every 2 shares,
1 share.
1 right share. Got it? So that is the ratio. That means a person holding 2 shares will have the right to buy 1 share in the company at rupees 120. Next.
Yes, sir. You are required to calculate number 1, the current market price of the share already in issue. Number 2,
Then remember we found already 160 rupees. Next.
the price at which the rights issue will be made.
That also
20.
we computed 120 rupees a share. Next.
The number of new shares that will be issued.
That also we found 2 crore 40 lakh by rupees 120 issue price. We got 2 lakh shares.
Rights.
So we already answered questions 1, 2 and 3. Now let us read the fifth subdivision first, and then you are supposed to answer the fourth one.
Yes, sir.
Let's go through the fifth subdivision.
The price at which the shares of the company should theoretically be quoted on completion of the rights issue.
That means what?
That
We have
is
been asked to find the theoretical X rights
excise price. Ignoring incidental and transaction costs.
Okay.
Assuming that the rate of return on existing funds is 12.5% and the market accepts the company's forecast of incremental earnings.
What is the meaning? Your current funds are giving a return of 12.5%. Whereas it's given that the money only raised now
Will give
via rights
15%.
issue. The 2 crore 40 lakh will give you 15% return, which is 2.5 percentage points more than the current yield. Yes or no?
Yes.
But how do you accommodate this information in calculating something called the the theoretical
The price of the share.
X rights price, or we say yield adjusted theoretical X rights price. Because in the earlier sum, we never had this issue. What is the assumption? Even the new funds raised will earn the same return as the old funds, existing funds. But here, the new funds will yield a 15% return on investment. Old funds only 12.5%.
Yes, sir.
Now tell me, what is 15 by 12.5? Is 1.2.
Yes, sir.
That means the new funds will yield a return which is 1.2 times the yield on old funds, right? That is the meaning. Now, how do you accommodate this in calculating the theoretical X rights price? Remember, I gave, there are two ways of finding out. One is you go to the market and buy 4 shares. Remember the previous sum, like that. Or I can use a weighted average share price. Yes or no?
Yes, sir.
Remember I did in the earlier sum.
4 by 5.
4 by 5 into 24 plus 1 by 5 into 16. I can do the same thing over here. Okay. Now tell me, we know that a persons holding 4 lakh shares can buy how many shares now? 2 lakh.
2 lakh shares.
2 lakh, right? They have the right to buy 2 lakh shares. Now when I say something right means, did you understand? Okay. Is that fine?
Yes,
okay.
sir.
So 4 lakh and 2 lakh. Now I can say is either 2:1 or I can add as 4 lakh and 2 lakh. I can say 4 lakh by 6 lakh is what? The weight for the old shares. And 2 lakh by 6 lakh. Right?
Yes, sir.
That's the weight for the new shares. Now just see the solution out there. Now how to calculate the theoretical X rights price? Let's finish out the first 3 subdivisions. No, we'll discuss first 3.
Yes, sir.
Then we'll take on the 5th one. And then we shall read the 4th subdivision later. Okay?
Yes,
Yes, ma. The first 3 you finish off.
So number 1, calculation of current market price of the share already in issue, which is earnings after tax 80 lakh, number of shares outstanding 4 lakh. So EPS is rupees 20 per share, which is 80 lakh by 4 lakh shares.
Okay.
Price earnings ratio is 8 times given. So market price per share is 20 rupees into 8, 160 rupees.
Next.
Price at which the rights issue will be made, 160 rupees into 0.75, 120 rupees.
That's 25% less or 75% of that, 120 rupees. Next.
The number of new shares to be issued is 2 crore 40 lakh divided by 120 rupees per share, which is 2 lakh shares.
Till that fine?
Yeah.
Now we shall go ahead and take on subdivision 5. Now how do you go about calculating the theoretical X rights price? Just see. Open brackets and write 4 lakh upon 6 lakh into 160 rupees a share. Sir, can I take 2 by 3? No problem. Not at all. Okay. No issues at all. So no problem. So take 2 by 3 into 160. It's up to you. That is 4 lakh and 2 lakh or 2:1, right?
Yes, sir.
2 by 3, the weight, or 4 lakh upon 6 lakh, all the same. That into rupees 160. That part is fine. But plus the second part, don't simply take 1 by 3 or 2 lakh upon 6 lakh into just 120. The reason is the 120 rupee what you're going to raise on every share is actually worth 1.2 times. Because 120 and 160 are not comparable. Why? The 160 rupees is giving only 12.5% return. Whereas a 120 rupees is giving how much?
15%.
Exactly. Now you try this. Okay, guys, do this for me. Now what is a 120 rupees into 1.2?
It's 144.
We'll work out 144, right? What is a 144 rupees? On that, if you take 12.5% return, it is as good as a 15% on 120. Yes or no?
Sir.
Check that. What is 120 rupees into 15%?
18.
18 rupees. What is 144 rupees into 12.5%?
18
Same 18. So basically, I'm trying to put a weightage on this number. 120 rupees actually is 1.2 times the weight of old funds, right?
Yes, sir.
That is why you'll see the calculation of there. 2 lakh upon 6 lakh or 1 by 3, that into 120 rupees, no doubt, into 15 by 12.5 or 0.15
By point
by
125.
0.1. It's all the same, right?
Yes, sir.
Into 15 by 12.5. Basically, you take 120 rupees into 15 by 12.5, you get 144. That into 2 lakh by 6 lakh or 1 by 3, 1/3, right? Weightage.
Yes, sir.
Add both, you get the theoretical X rights price. Guys, this sum is from the CMA examination. Okay?
Yes, sir.
Is it marked out there?
Uh,
The question, they marked CWA final.
I'll just check, sir.
Just check.
Yes, sir. CWA final December 2005.
This sum is actually taken from an ACCA textbook. Okay. So learn this sum really well for your examination. Okay.
Yes.
You don't find such an example in your study mat. Now this number is called the yield adjusted TERP. What is TERP? Theoretical X-rights price. But there is an yield adjusted TERP, TERP, right?
Yes,
Adjusted for the yield. Suppose they haven't given 15% is a, what is that? Is a new yield. Then like the previous sum I could have done. What is that? 2 by 3 into 160 plus 1 by 3 into 120. Got it?
Yes, sir.
But here yield adjusted TERP.
Yes.
How much you got? 154.
154.67.
That's it. Now let's go back and read what is the fourth subdivision.
Valuation of right.
Find the value of a right. So in this case, you know the formula. Take the theoretical X rights price. What you got? Yield adjusted 154.67 minus
a rights issue price.
rights issue price, which is 120 rupees. So rupees are 34.67. That is supposed to be the value of the right. Got it? Guys,
Yes, sir.
is that fine?
Yes, sir.
Now, before you can go ahead and take down the solution in your notebook, just listen to me very carefully. In the ACCA textbook, okay, Renuka,
Yes, sir.
they did not specify the 12.5% yield on existing funds. That wasn't given. So you had to calculate that. They just said that is the yield on new funds will be 15%. And they never said what is the yield on old funds, existing funds, right?
Yes, sir.
That is 4 lakh shares into rupees 50, no, the money employed currently, the capital employed. They didn't say yield on existing fund, they didn't give the number. So you had to calculate that because you have been asked to find anyway yield adjusted TERP. Now how do you find the yield on existing funds? What you can do? You can do this. Now tell me, now what is the earnings per share currently? 20 rupees.
20
Remember we got.
rupees.
And what is the market price per share?
160 rupees.
Suppose somebody wants to buy a share today in the market, they have to pay how much? 160. If the company is going to earn the same earnings, how much? They'll earn only 20 rupees. What is the return on investment for the investor? So divide 20 rupees
By
by 160 rupees into 100,
12.
you will get 12.5%. Understood?
Yes, sir.
They did not specify the yield on existing or the old funds. So you have to find this way. You can take the earnings per share by market price per share into 100. Think logically. If somebody wants to buy a share in this company today, they got to pay 160 for the share, right?
Yes, sir.
Which is currently trading at 160. Suppose a company earns the same EPS next year, 20 rupees. What is the return on their investment or yield on their investment? It is 20 rupees upon 160 into 100, how much? 12.5%. Got it?
Yes.
Please have this in mind. Your examiner may not give the 12.5%, but still they'll say calculate the yield adjusted theoretical X rights price. In that case, this is a way you're going to calculate the yield on existing funds. So guys, pause the recording and jot down the solution in your notebook.
Yes, sir.
Now let's go ahead and take on one more example on rights issue that reads Sony PLC. Here we go, and the numbers are in in a different currency, GBP, in pounds. And don't think it's a forex example. It is an example on a rights issue. Yes, ma.
The stock of Sony PLC is selling for 50 pounds per common stock. The company then issues rights to subscribe to one new share at at pound 40 for each 5 rights held.
It is given that for every 5 shares held, that is, in case you go to the market and buy 5 shares, which includes the payment for rights as well, right? So therefore, for 5 rights, or say for 5 shares, you are given the right to purchase one extra share in the company at 40 pounds each. And currently the shares are trading in the market at how much? At 50 pounds. Next.
A. What is the theoretical value of the right when the stock is selling rights on?
Okay, then.
And B. What is the theoretical value of one share of stock when it goes X rights?
Okay. Now first we should find the theoretical value of a share X rights first. And then I can answer the question, what is the value of the rights? Is that fine?
Yes, sir.
Now please refer to the handwritten solution. Let us take on subdivision B first.
Yes, sir.
And then answer to subdivision A. Now we know that to calculate the theoretical post rights price of a share, we use a formula. What is that? You can take 5 shares which are currently trading at 50 pounds each. Okay. And it's given, I think the question, the rights are on. Okay.
Yeah.
For the first 2 subdivision, rights are on. The rights on means, that means the company has made the offering, right? And anybody purchasing shares in the market will be entitled to the right shares. That is the meaning. So over here is going to be 5 shares into 50 pounds each, plus 1 share you can buy at 40 pounds each. The whole divided by 6 shares in all, right? 5 plus 1, which will work out to, that is 290 pounds upon 6, which is pounds 48.33. Now there is another way to find the 48.33 pounds. What you can do? The weighted average approach. You can take 5 by 6 into 50 pounds plus 1 by 6 into 40 pounds. Add both 41.67 and 6.67 or 66. Adding both, you'll get 48.33. That is supposed to be the theoretical X rights price of a share. Is that fine?
Yes, sir.
And then number 2, you have been asked to find the value of the right. There are 2 ways of finding out. Either you can find for straight away 48.33 minus 40, that will suffice actually, which is 8.33 pounds per right. Or in case you want to find a per old share, remember you got to hold the 5 shares to purchase at 1 share, right? I can divide 8.33 divided by 5, which is 1.67 per share. Or there's another way to get 1.67, not there in the handwritten notes. You can take 50 pounds, which is the current market price, minus of 48.33. How much you get? 1.67. That means for every share you buy in the market at 50 pounds, that includes a 1.67 for the right. What is 50? Dirty price. And what is 48.33? The clean price. That 1.67 is extra you pay for the rights attached. Is that fine?
Yes.
You got to buy 5 rights, 5 shares to get that 1 share at 40 pounds each. Got it?
Yes.
Is that clear? You either give the answer as 8.33 pounds or 8.33 divided by 5. My advice will be the 8.33 will suffice. Is that clear? Now let us go to subdivision C, the third question. Go back to the question.
Yes, sir. See, what is the theoretical value of a right when the stock sells X rights at £50.
Suppose the 50 pounds represents a X right price. Suppose the X right price is 50 pounds. What is the value of right? Very simple. 50 minus 40. The X right price minus the issue price. The rights issue price.
Yes, sir.
50 pounds minus 40, how much?
10.
10 pounds per right. Again, if you want, you can give the answer 10 pounds
By 5.
by 5.
Shares.
It is 2 pounds for every old share that you buy. Got it?
Yes, sir.
So 2 pounds per share. Or the best answer is 10 pounds per right. Enough. Is that clear?
Yes, sir.
So have this in mind, the 10 pounds per right. Now let's go to the next question.
John, speculator, has £1,000 at the time Sony PLC goes X rights at £50 per common stock. Now he feels that the price of the stock will rise to £60 by the time the rights expire. So compute his return on his £1,000 if he, number 1, buys Sony PLC stock at £50, or number 2, buys the rights as the price computed in part C, assuming his price expectations are valid.
Okay.
Yes.
Now let us assume that I represent John. And please remember, there is something called the record date. Now whenever the right shares are offered by a company, let us say on 15th of November, they will set the record date as, let us say, 26th of November. It is only persons holding shares on 26th of November will be entitled to rights shares. Is that fine?
Yes.
Got it? And it also specify the date on which, by which you can renounce the rights. Let us say in our example, 11th of December. And there will also be a date set for the last day for you applying for shares in the company. Let us say 17th of December. Is that fine?
Yes.
Remember these dates. 26th of November is a record date. And then 11th December. By 11th December, if you want, you can renounce your right. And then by 17th of December, a person can apply for shares in the company. Is that fine?
Yes, sir.
Where the rights, no, your entitlement will expire by 17th of December. Now, let us say I represent Mr. John. I have £1,000 with me. Now, I am going to buy the shares after the record date. Remember, just after reach the record date, the shares will go X rights. Because the market knows that anybody purchasing shares after record date will not be entitled to rights issue. Your name should have been there on the record date, right? As a shareholder. So if I want to buy the shares after record date, I can go buy the shares in the market for how much? £50 given. It is given the question that the X right price is £50, right? £50 X right. I can buy for £50. Now tell me, with £1,000 I can buy how many shares in the market, Renuka? £1,000
Yes, sir.
divided by £50 per share. I can buy 20 shares in the market. And then by the time we reach December 17th, let us say the shares are trading at £60 each. I can sell the 20 shares in the market for how much? For 60 pounds. And I can pocket how much? I pocket £1,200 I pocket. Is that fine?
Yes, sir.
I pocket £1,200. So £1,200 minus £1,000 what I invested, I gain £200. If you want, you can also express this as a percentage return. £200 upon £1,000 into 100, nothing but 200
20%.
divided by £1,000 into 100 is what? 20% return on my investment. Okay.
Yes, sir.
I have one more option. what I can do? Let us say Renuka is a shareholder in this company. Now I can, let us say she doesn't want to exercise her rights. So she wants to sell the rights to me. With 1,000 pounds, I can buy how many rights from Renuka ma'am? Let's see. Now we know that subdivision C, when the price is 50 pounds X right. Got it? When the X right price is 50 pounds, what is the value of right? We got 10 pounds. Remember?
Yes.
Subdivision C, 10 pounds per right. With 1,000 pounds, I can purchase how many rights from Renuka ma'am? 1,000 pounds by 10 pounds. I'll buy 100 rights. Maybe on 27th or 28th of November, I'll buy 100 rights from Renuka because the last day to renounce is December 11th.
Yes.
But she says, I don't want the shares. Anyway, you take the rights. I'm going to buy the rights from Renuka ma'am. 100 rights, I'm going to buy at 10 pounds per right. Then, by the time we reach, say, around, the 11th of December, let us say the share price has gone to 60 pounds. Now, what I can do? I can sell those shares I can sell the rights in the market. Now, what will be the value of right once the price goes to 60? It will be 60 pounds share price, X right, minus what is the rights issue price? 40. What is 60 minus 40?
20.
One right will be trading for 20 pounds each. Got it?
Yes, sir.
So, I can sell those 100 rights in the market to somebody else who wants to buy the shares in the company. Maybe they can buy it by 17 December, right?
Yes, sir.
So, I can sell the rights to another person. Let's say we create one more person, X. I will sell the rights to X. And how much I will earn?
20.
I can sell every right for 20 pounds, right? Because 60 minus 40. Because shares will be trading at 60. 40 will be the rights issue price. 20 pounds will be the value of one right. So, what is the 100 rights into 20 pounds?
2,000.
I will pocket 2,000 pounds by selling those 100 rights. I will pocket 2,000 pounds minus how much I invested? 1,000 pounds. So, what is the profit I make? 1,000 pounds profit. If you want the percentage, it is going to be 1,000 pounds profit upon 1,000 pound investment into 100, how much?
100%.
100% is my return on my investment. Got it?
Yes, sir.
Okay, guys.
Yes, sir.
So please go through this example, a really good example. Pause the recording and jot down the solution.
Yes, sir.
Okay, so guys, let us go ahead and take on the last concept in this particular chapter, that is on buyback of shares. That is what is the financial effect of a stock or a share buyback. Here we go. Yes.
Abhishek Limited has a surplus cash of 90 lakh rupees and wants to distribute 30% of it to the shareholders.
Now, what is 90 lakh rupees into 30%?
30 lakh.
27 lakh rupees is a surplus. They want to distribute. There are two ways. Either the company can pay rupees 27 lakh as dividends, or they can use the money to buy back shares from the shareholders. Got it?
Yes, sir.
It is very similar to like paying dividends will be like uncommuted pension, where the shareholders can earn dividends every year, right?
Yes, sir.
And this is like a commuted pension. Which one? A buyback, where you want to pay 27 lakh rupees to the shareholders, or one lump sum, and buy the shares from them. Got it?
Yes.
Yes, ma.
The company decides to buy back shares. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price.
It is given that your share price, price per share after buyback will be 10% higher than the buyback price.
If buyback route is taken.
In case you decide to go the buyback route. You can either pay dividends or take the buyback route. Okay, or route. Okay, it's up to you, which you want to pronounce. But the point is, share price will be 10% higher. Okay, 10% higher than the buyback price. That means suppose a buyback price is, let us say, is P. What will be the share price after buyback? It will be 110% of P. 1.1 P, right?
Yes, sir.
1.1 times P. Suppose the buyback price is rupees, let us say, for example, random, I'll choose some random number, say 50 rupees. What will be the buyback price? 10% higher means what? 55. Is as good as 1.1 into 50, right?
Yes, sir.
Next.
The number of shares outstanding at present is 10 lakh and the current EPS is rupees 3.
Very clearly given that the number of shares outstanding are 10 lakh shares at present. The EPS is 3 is nothing but 30 lakh should have been the earnings. Divided by 10 lakh shares is equal to how much? Rupees?
3.
3 per share EPS. They given the EPS 10 lakh shares. That means rupees 30 lakh is the earnings or profits after tax available to shareholders. Next.
You are required to determine A. The price at which the shares can be repurchased if the market capitalization to the company should be 200 lakh after buyback.
So it's given that calculate the buyback price. In case a market value of the shares after buyback, that means what? 10 lakh shares are there, minus the number of shares bought back, you subtract, which you don't know, that into the price after buyback, which will be 1.1 times P, is equal to how much? 200 lakh. You all know what is market cap. It is the number of shares in issue outstanding, that into the price per share. Is that clear?
Yes.
Got it? Therefore, that is 200 lakh, the market cap after buyback. Now, calculate the buyback price, the question. Next.
B. The number of shares that can be repurchased.
Now, how many shares can be repurchased with rupees 27 lakh once you calculate the buyback price? And number 3.
The impact of share repurchase on the EPS, assuming the net income is the same.
That's it. These are the questions hurled or thrown at you. Okay.
Yes.
Now, let us go ahead and take on the solution. And here first you got to assume that let the buyback price be what? P. The buyback price is P and the market price after buyback will be 1.1 times P, 10% higher. Got
Yes,
it?
sir.
1.1 P. Yes, ma.
Yes, sir. So let P be the buyback price decided by Abhishek Limited. The market capitalization after buyback will be 1.1 P into original shares minus shares bought back.
Now, how do you find the shares bought back? You want to spend 27 lakh rupees, right? You want to go shopping. You want to buy your own shares in the market. 27 lakh rupees you want to use for buyback. And what is the price of one share buyback price? P.
P.
You can buy how many shares? 27 lakh divided by P is the number of shares you can buy. Got it? Now see the calculation.
So
1.1 P is what? Is a price per share after buyback. That into open brackets 10 lakh shares are there before buyback. Got it? Minus you want to buy back how many shares? 27 lakh rupees.
Divided
Which is
by
30% of 90 lakh, right? 27 lakh divided by what?
P.
The buyback price P, close brackets. When you multiply 1.1 P into 10 lakh,
11.
will give you 11 lakh into P or 11 lakh P. Yes or no?
Yes, sir.
You can write that as 11 lakh P minus, remember 1.1 P into 27 lakh divided by P. That will work out if P gets cancelled.
So
You get 29.7 lakh rupees. Therefore, I can say that the market cap after buyback will be 11 lakh P minus 29.7 lakh.
Which is equal to 200.
Which is equal to 200 lakh market cap amount is given.
Yes, sir.
Now, if you solve, you will get 229.7 lakh divided by 11 lakh will give you P. How much you get?
20.88.
And that is your buyback price. That is a price per share, the buyback price. Now, if we divide 27 lakh rupees, the amount you're going to spend on buyback, by rupees 20.88 per share, will give you a number of shares you can buy back. How many shares?
It is 1.29 lakh shares approximately.
You can buy 1,29,000 shares out of the 10 lakh shares in the market. Got it?
Yes, sir.
Which is 1.29 lakh shares can be bought back. Now, what is the impact on EPS now? We know the earnings doesn't change. It's given 30 lakh rupees will be earned. Divided by the number of shares will be 10 lakh minus 1.29 or 1,29,000 shares.
8.71 lakh shares.
So divide rupees 30 lakh by 8.71 lakh shares. How much you get?
3.44.
The earnings per share increases by
44.
3.44, right?
3.44 is the
So 0.44 is the increase. The EPS is 3.44 per share. That is the earnings per share. It increases by rupees 0.44. Is that clear?
Yes, sir.
So guys, go ahead and jot down the solution in your notebook.
Yes, sir.
Now let's go ahead and take on the next example that reads Rahul Limited. Yes.
Rahul Limited has surplus cash of 100 lakh rupee and wants to distribute 27% of it to the shareholders.
So 27% of rupees 100 lakh, again 27 lakh rupees they want to distribute. Next.
The company decided to buy back shares. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price if buyback route is taken.
Again 10% higher than the buyback price. Again it's going to be 1.1 times P. Next.
Number of shares outstanding at present is 10 lakh and the current EPS is 3 rupee.
Same 30 lakh earnings. Next.
You are required to determine number one, the price at which the shares can be repurchased if the market capitalization of the company should be 210 lakh after buyback.
The only change 200 lakh, how much?
210 lakhs.
Rupees 210 lakh. That is the only change, but for that very similar sum, right?
Yes, sir.
So just see the calculation out there, 1.1p. That into in brackets.
Original shares.
It is 10 lakh shares.
Minus shares bought back.
Minus 27 lakh divided by P. Now when I solve this, how much I get? 11 lakh into P, 11 lakh P.
Minus 29.
Minus 29.7 lakh.
Which is equal to 210.
Which is equal to 210 lakh. Or 210 lakh plus 29.7 lakh.
Is equal to
divided by 11 lakh. Equals P. How much you get?
We get 21.79 per share.
That is the only change. Now divide rupees 27 lakh by 21.79. The buyback price. You get number of shares that can be bought back. How many shares?
1,24,000 shares or 1,23,910 shares.
Okay, 1,23,910 or 1,24,000 shares are bought back.
Round.
Now earnings per share will be rupees 30 lakh, numerator no change. Divide by how many shares?
8.76 lakh.
Which is nothing but 10 lakh minus 1,24,000 shares.
Yes, sir.
Which gives how much?
3.43.
That's it. That is the earnings per share. Is that clear?
Yes, sir.
So guys, pause the recording and jot down the solution.
Yes, sir.
Okay, so now we shall go ahead and take on one more example on stock buyback. And this question appeared in May 23 examination. Here we go with the question. Yes.
High Growth Limited was having an excellent growth over a number of years. The board of directors is considering a proposal to reward its shareholders by buying back 20% shares at a premium. The premium is to be paid by raising a loan from the bank. The interest on loan is to be serviced by internal accruals as supported by the financials of its HGL. The company has a market capitalization of 15,000 crore rupee and current earnings per share is 600 rupee with a price earnings ratio of 25 times.
Yeah, guys, listen over here. They are given the market capitalization. which is nothing but the number of shares in issue, that is shares outstanding, that into the price per share on that date is rupees 15,000 crore. Now they given the data for you to calculate the current market price of a share, because they given the earnings per share to be rupees 600, and also they given the price earnings ratio to be 25 times. Now you all know that price earnings ratio times, that is into EPS, will give you the market price per share. Now that is 25 times rupees 600, that is 25 into 600, how much you get? 15,000 rupees will be the price per share, that is supposed to be the current market price. Is that fine?
Yes, sir.
Now if I divide 15,000 crore, which is the market cap, that is the number of shares into the price per share, is 15,000 crore. Now if I divide that by that 15,000 crore rupees by the market price per share, 15,000 rupees per share, I'll get the number of shares in issue, which is what? 1 crore. Yes?
Yes.
That is shares outstanding as on that date when the company is going to make an offer for buyback. Is that clear? On the offer date, your company shares are trading at 15,000 rupees and there are 1 crore shares in issue, that is outstanding on the balance sheet. Next.
Yes, sir. The board expects a post-buyback market price per share of rupees 10,000.
It is given that rupees 10,000 will be the post-buyback price. That is after buyback, the price per share will become how much? Rupees 10,000. From 15,000 rupees, it will come down to rupees 10,000. Next.
The price earnings ratio post-buyback will remain the same.
It is given that the price earnings ratio will be the same. That means what? 25 times. And you all know that price earnings ratio is nothing but market price per share divided by EPS. Or if I am given the price earnings ratio to be 25 times, which is equal to 10,000 rupees market price divided by EPS, I don't know the post buyback EPS, I can find out, yes or no?
Yes.
If I divide 10,000 rupees by 25, I will get the post buyback EPS will be rupees 400. Is that fine?
Yes, sir.
From rupees 600 per share come down to rupees 400 per share. Next.
The loan can be availed at an interest rate of 16% per annum.
It is given that your company is going to borrow money for the purpose of buyback, right? It is given the loan will be borrowed at an interest rate of 16%. Suppose the loan amount is L or X. That into 16 by 100 will give you the amount of interest you're going to pay on the loan. That will be borrowed for the purpose of buyback. Is that fine? You're going to use the loan funds to buy back. Next.
Applicable corporate tax rate is 30%.
It is given tax rate as 30%. And also given earlier the company wants to buy back 20% of its shares, right? What is 1 crore shares into 20%? Your company wants to buy back 20 lakh shares in the market. But here the buyback price is not given in the question. How do you find that? You got to find how much a loan your company wants to borrow, and that will determine the buyback price. Because you want to buy 20 lakh shares by taking a loan, right?
Yes.
Yes.
So you are required to calculate, number one, the interest amount which can be paid for availing the bank loan.
What is the amount of interest you can afford to pay? Got it?
Yes, sir.
That is for the purpose, a loan to be borrowed for the purpose of buyback. Number two.
Number two, the loan amount to be raised.
The loan amount to be raised.
And number three, buyback premium per share.
Okay, 3 questions. Okay. Now take this. Please refer to the solution. We know that rupees 600 is earnings per share before buyback. We also know the price earnings ratio is 25 times.
Yes, sir.
From our discussion, remember 25 times rupees 600 gives you 15,000 rupees per share, the price, the market price per share. Now divide a 15,000 crore by 15,000 rupees per share will give you what? 1 crore shares will be bought, or will be, that is shares outstanding, sorry, okay?
Yes, sir.
Of these 1 crore shares, you want to buy back 20%,
20%.
which will be 20 lakh shares, leaving a balance of 80 lakh shares after buyback. Yes,
Yes, sir.
in the hands of the shareholders. Now, what will be the post buyback earnings per share? Remember, it is divide 10,000 rupees by 25 times will give you rupees 400 per share.
Share.
Now, my task will be to calculate the earnings after tax, the profits available to equity shareholders
Yes, sir.
after paying 30% tax, before buyback and after buyback. Before buyback, very simple. There are 1 crore shares outstanding, right? And the earnings per share is rupees 600
Yes, sir.
given. Now we know that what is earnings per share formula? I take the profit after tax available to equity shareholders divided by 1 crore shares is equal to rupees 600. Or I can take 1 crore shares outstanding into rupees 600. How much I get? 600 crore is your post-tax earnings, PAT, before buyback. Yes or no?
Yes.
But how do you find the pre-tax profits? Very simple. It is given the tax rate is how much? 30%.
30%.
That means what? This 600 crore represents 70%, the balance. If the tax rate is 30%, what is the meaning? Suppose your company earns rupees 100 pre-tax profits. On that 30% tax will be rupees 30 tax gone. The government takes a bite. Okay, the tax goes away, leaving a balance of rupees 70 in your hands. Yes or no?
Yes, sir.
Therefore, 600 crore represents 70%. What is for? 100.
100%.
That is what is captured in that working. 600 crore
Divided by 1
divided by
minus
1 minus 0.3. It is as good as rupees 600 crore into 100 by 70, which gives you
57.1429.
crore rupees will be a pre-tax profits. Yes?
Yes, sir.
Before buyback. How to find the pre-tax profit post buyback? We know rupees 400 is the earnings per share. And that into 80 lakh shares outstanding. That is post buyback.
Yes, sir.
That gives an amount of rupees 320 crore as your post-tax profits of PAT after buyback. How do you find the pre-tax profit after buyback? Take 320 crore, divide by 70 into 100, or divided by 0.7. How much you get?
457.1429 crore.
Please remember, the pre-tax profit, PBT, is 857.1429 crore before buyback. After buyback, it can come down to how much? 457.1429 crore. That means your profits can come down by rupees how much? 400 crore. Very clearly given in the question that the company will pay interest on the loan out of its internal accruals. That means what? Out of profits. Got it? Therefore, your profits can come down to, if your pre-tax profits are 857.1429 crore, it can come down to 457.1429 crore. That means your company can afford to pay how much interest on the loan? 400 crores. Yes or no? That is the amount of interest a company can afford to pay. Remember, your PBT, profit before tax. Okay? Let's assume your company is right now unlevered. No interest at all. So your PBIT also is how much? It is 857.1429 crore, right?
Yes.
That amount can come down to 457.1429 crore after you pay interest on the loan borrowed for the purpose of buyback. Is that clear? So 400 crore is the interest you can afford to pay. That is the answer to the first question, right?
Yes, sir.
How much interest you can pay? 400 crore. That is the first question answered. We also know that you have been asked about the loan amount.
Yeah.
You know the loan amount. Loan amount is, say, let us say XL. Okay, loan amount into 16 by 100, the rate of interest is equal to how much?
400.
400 crore. Or loan will be 400 crore into 100 by 16, or as good as divided by 0.16. Yes or no? So your company can borrow rupees 2,500 crore for the purpose of buyback. Yes or no? Rupees 2,500
500 crore.
you can buy. That is, you can borrow for the purpose of buyback. Got it? That is amount of loan you can borrow. Now you cross check also. What is 2,500 crore loan into 16% interest will give you rupees 400 crore. Understood?
Yes, sir.
Now tell me, this amount you want to borrow for the purpose of buyback. And how many shares you want to buy back? 20 lakh. Now divide rupees 2,500 crore. That's crore, okay? Divide that by 20 lakh shares. 20 lakh.
Yes, sir.
Which is 0.2 crore shares. Got it? If you divide rupees 2,500 crore by 20 lakh shares, you'll get a buyback price of rupees 12,500 per share. But now there is a flaw in the question. You have been asked to calculate the buyback premium. Remember, buyback premium means
Yes, sir.
it is nothing but it is a premium, the buyback price in excess of the market price of the company shares when the offer is made for buyback. Got it?
Yes, sir.
Example, TCS. When they bought the shares, that is on October 11th, 2023, they made an offer for buyback.
Yes, sir.
Now they offered a buyback price of 4,150 rupees, which was a 15% premium to the closing price on 11th October. Got it?
Sir.
Basically, you are supposed to compare 12,500 with 15,000 rupees. This is where people got bamboozled in the exam. They were stunned. They it's in fact it's below the market price, not above. But remember, generally in the real world, the buyback price offered will be higher than the market price. If you're going to offer something less than market price, there is no incentive for the shareholders to offer their shares to the company. Got it?
Yes, sir.
Yes. So please remember, but here what he has done is he has found the buyback premium by comparing 12,500 buyback price with the post buyback market price. How much? 10,000 rupees. And the answer given is 2,500 rupees is a premium per share on buyback. Got it?
Yes, sir.
But which is not the right answer. In fact, the buyback price is rupees 2,500 less than the current market price. Got it?
Yes, sir.
But just to be with the answer, you can say it's 2,500 premium. But the truth is, people can check the news article on TCS buyback in the year 2023. It says very clearly the company offered a buyback price of 4,150 rupees, which is a 15% premium on the closing price as on 11th October 2023. Is that fine?
Yes, sir.
Got it?
Yes, sir.
So guys, that is all with this example. Please go ahead and jot down the solution in your notebook. And with that, we complete this topic on rights, bonus and buyback.
Yes, sir.